Hello again. This is Doc from OnTheMoneyOptions.com. Are you a little afraid of jumping into or being in the stock market right now? Are you hedged properly in all your positions? Or are you sitting in cash wondering when is a good time to invest? Well, today I'm going to show you how you might take a position right now that will be beneficial to protect you if the market moves down. This content's normally reserved for full members of OnTheMoneyOptions.com, but it's a beautiful day on the coast of North Carolina and I feel like sharing with my friends. So let's jump in and see if this is a good time to buy bonds. This is a chart showing the exchange traded fund called TLT. This ETF contains 20-year U.S. Treasury bonds and can be bought and sold like a stock. In the lower pane of this chart is the S&P 500 index. What I want you to notice is that the TLT is positively correlated with the S&P 500. This means that as the S&P 500 moves up over a long period of time, the TLT moves up with it. But the TLT does something different when the S&P makes a downturn. Let's focus on a specific period of time on this chart. Look at the performance of TLT when the S&P 500 turned down sharply in 2008. When investors get nervous, they crowd into bonds. This drives the price up. I'm going to highlight some periods when you see this happen. You will also notice that the TLT conforms nicely to a long-term uptrend line. The trend line connects the lows of the long-term trend. You see that TLT comes down near the trend line and then reverses back up. Most are familiar with the old adage, buy low and sell high. The long-term trend line shows you an area where buying the TLT might be beneficial. Right now the TLT is near the trend line and the S&P 500 feels a little extended. So now may be an opportune time to add a position in TLT. Investors complain about the yield available in bonds these days, but I'm going to show you a method to enhance that yield. It's called a covered call. In our example, we will purchase shares of TLT in 100 share increments. The reason? Stock option standard contracts are for 100 shares each. Now, if you can't afford to buy 100 shares of TLT, there's a way to do that with the stock replacement call option, but that's a topic for another time. So let's look at a simulation of the trade. We start by purchasing 100 shares at $121.02. Looking at the profit graph of just the stock position, you see that we have a break even of our current price at 121.02, and as the price of TLT moves up, so will the profit of the position. Now let's look at how we can use this position to generate some income. We're going to sell a covered call at a price just above the current price of the stock. In this case, we will sell the March 122 call option. The call option will give someone the right to call the stock away from you at $122 per share. And for that right, they're going to pay you $1.18 per share. This call premium goes in your pocket. Looking again at the profit graph, you can see the call premium we've received has lowered our break even from $121.02 to $119.85. But you've capped your maximum return at $122. So let's review the possible outcomes. The price of TLT may go down, and in this case, the value of your position will go down, but you keep the premium on the covered call. The second outcome is the price of TLT stays the same or stays below $122. In this case, you continue to own the stock, but you keep the premium on the covered call. The third outcome is that TLT goes up above $122 per share and the covered call is exercised and your shares are purchased at $122. What I want to point out to you is that in all outcomes, you keep the covered call premium paid to you. The covered call was sold for the March series and will expire on March 17th, which is about 34 days from now. So let's look at the results. First of all, you've received $1.18 in call premium on a $121 investment. That's nearly a 1% return in 34 days. If you can make 1% per month on Treasury bonds, that wouldn't be so bad, would it? Now look at your return if TLT goes above $122. Your stock will be called out at $122. Your break even was 121.02 minus $1.18, or a break even of $119.85. So $122 minus the $119.85 is a $2.15 profit in 34 days. That's a 1.8% return on a $119.85 investment. The important thing to remember is TLT oftentimes pops up if the major indexes go down. So this position is a good hedge against a market downturn. I hope this gives you some ideas for making some money when the equity markets seem to be overbought. So until next time, this is Doc saying so long and stay hedged.